Okay, good day. Once again, I'm Teacher Lee. Now we're going to discuss tax on domestic corporations. So for the overview of the chapter, we're going to discuss the definition of corporation, the different types of corporations, taxability of domestic corporations, the categories of income subject to tax of a domestic corporation like capital gains, passive income, other income or active income or regular income, income tax rules on domestic corporations, particularly capital gains taxation, final tax on passive income, normal tax, minimum corporate income tax expense, quarterly tax on corporations, and improperly accumulated earnings tax. Let me share to you an overview of how corporate income taxation applies in the Philippines in general. So let us start with an understanding of the thing called corporation by its nature as defined in the Corporation Code of the Philippines. So according to the Corporation Code of the Philippines, it is defined as an artificial being created by operation of law, having the rights of succession and the powers, attributes, and properties expressly authorized by law or incident to its existence. For tax purposes, the National Internal Revenue Code of the Philippines defines corporation will include partnerships, no matter how created or organized, joint stock companies, joint accounts or cuentas en participación, association or insurance companies, but does not include general, professional, partnerships, and joint venture or consortium formed for the purpose of undertaking construction projects or engaging in petroleum, coal, geothermal, and other energy operations pursuant to an operating consortium agreement under a service contract with the government. So the term corporation includes partnerships. There are different types of partnership and it does not include under corporation the general professional partnership. When you say general professional partnership, this is a partnership formed by persons for the sole purpose of exercising their common profession. So no part of the net income of which is derived from engaging in any trade or business. So when two persons or two or more persons form a partnership for the purpose of exercising their profession, then that will be considered as a general professional partnership. Let's say, for example, one person is a certified public accountant and another person is also a certified public accountant, and they agreed to form a partnership for the purpose of exercising their profession, that is to audit the income tax returns of companies in Ilocos Norte. So that partnership that is formed there is considered as general professional partnership because they have common profession to exercise. Now, other partnership are considered as corporations. So, partnerships that are not considered general professional partnerships are considered as corporations. When we say joint venture, this is a cooperative enterprise entered into by two or more business entities for the purpose of a specific project or other business activity. So in here, it does not include those engaging in petroleum, coal, geothermal, and other energy operations. So ang kasali lang as corporation are partnerships, no matter how created or organized, joint stock companies, joint accounts, association or insurance companies, and yung mga corporations talaga. Okay, now for income tax purposes, a corporation is further classified as follows: domestic corporations and foreign corporations. Foreign corporations may either be resident foreign corporation or non-resident foreign corporation. Let's discuss first domestic corporations. Domestic corporations are corporations created or organized in the Philippines or under its laws. So the Securities and Exchange Commission or SEC issues a certificate of registration to domestic corporations and its legal personality commences or starts upon the date of approval of its articles of incorporation. So examples of these are Jollibee Food Corporation, BPI, Meralco, Ayala, BDO, San Miguel, Globe, and other companies that are created under Philippine laws. Meanwhile, foreign corporations are corporations organized under laws of foreign countries. And this may be classified into resident foreign corporation or RFC. This applies to a foreign corporation engaged in trade or business within the Philippines. So SEC normally issues a license to do business in the Philippines to authorize their engagement in trade or business in the Philippines. So examples of these are Philippine branch of foreign corporation, like for example, Standard Chartered Bank, Hong Kong and Shanghai Banking Corporation, regional operating headquarters of multinational companies, regional or area headquarters of multinational companies, representative offices. Another type of foreign corporation is the non-resident foreign corporation. This applies to a foreign corporation not engaged in trade or business within the Philippines. So there is no need for license to do business as they do not normally have presence in the Philippines but allowed to earn income in a way or another. An example of this may be the Universal Studios, the Disney, and other movie producing companies wherein they put their movies here in the Philippines for showing, but they do not have offices in the Philippines, but they are earning income in the Philippines. Now, taxability of income of domestic corporations would depend on the nature of income and the type of corporation. So it would be too confusing to discuss them all like the domestic corporation, resident foreign corporation, non-resident foreign corporation. So let us just limit our discussion for now to domestic corporations. So income, as to nature of income, may be classified as follows: capital gains, passive income, active or regular income or other income. So first, let's discuss capital gains. So when we say capital gains, these are gain on sale, exchange, or disposition of capital assets. Actually, there are two types of assets. We have the ordinary asset or those assets that are used in the ordinary course of the business, yung mga ginagamit talaga dun sa business. Like for example, factory building, accounts receivable, notes receivable, inventories, supplies. Those are examples of ordinary assets. Office building is also considered as an ordinary asset. While capital assets are those that are not used in the ordinary course of the business. Those are assets that are held for investment purposes. So, examples of capital assets are gain on sale of shares of stocks, gain on sale of bonds, gain on sale of real property. So for income tax purposes, for capital under capital gains, we will only consider those capital assets. Now for passive income, these are income earned with very minimal or even without active involvement of the taxpayer in the earning process. So walang masyadong involvement si taxpayer. So hindi siya masyadong nag-exert ng effort. So like say for example, naglagay lang siya ng pera dun sa bangko, natulog siya, pero habang natutulog siya, nag-earn na yung income niya dun sa bangko. Nag-earn na ng interest. Okay? Or nag-invest siya sa isang company. Okay? And yung company, nagbibigay ng mga dividends. Okay? So, those are examples of passive income. Royalties are also examples of passive income when a company creates a book or publishes a book and it earns royalties, that is also considered as passive income. Okay? So kahit na matagal nang nakapublish yung book, pero habang binibenta siya ng every year, nag-earn pa rin siya ng royalties. So kahit wala nang ginagawa yung company, nag-earn pa rin yun ng royalties or passive income. Now, the third category is active or regular income. This income requires active involvement of the taxpayer. So, in here, an example is the business income of the corporation. So, these three categories of income, capital gains, passive income, and regular income, are subjected to different income taxation schemes. So, capital gains tax, final income taxation, and corporate income taxation. Now, some capital gains may be subject to capital gains tax, while the others will be subjected to corporate income taxation. So, meaning not all capital gains are subject to capital gains tax. Other capital gains may be subjected to corporate income taxation. Once a capital gain is subjected to capital gains tax, it will no longer be subjected to corporate income tax. The same is true with passive income. Some passive income is subject to final income taxation, while others are subject to corporate income taxation. Meaning, not all passive income are subjected to final income taxation. Others may be subject to corporate income taxation. When a passive income is already subjected to final income taxation, it will no longer be subjected to corporate income taxation. Okay? So those that do not qualify under final income taxation will fall under corporate income taxation. Now, for active or regular income or other income, these are always subjected to corporate income taxation unless there is an exemption to the rule or there is a tax exemption to the rule. So with this, not all capital gains are subject to capital gains tax. So please remember this, not all passive income is subject to final tax. Okay? But other income or active or regular income is subject to corporate income tax. And there are capital gains or passive income that are subject to corporate income tax, like for example, interest on notes receivable, these are capital gains. Capital gains on sale of shares of stocks of a resident corporation, these are capital gains, but they are not subject to capital gains tax, but they are subject to corporate income taxation. And interest on notes receivable is a passive income that is not subject to final income taxation, but are subject to corporate income taxation. So let's discuss first capital gains taxation. There are two transactions that are qualified to be under capital gains taxation. The sale of shares of stocks of a domestic corporation not listed and traded in the local stock exchange held as capital asset. In here, there is only a tax if the sale resulted in a gain. And the final tax rate is 15%, which is based on net capital gain, meaning selling price less cost. The second transaction that qualifies under capital gains taxation is the sale of real property located in the Philippines held as capital asset. Now in here, there is a tax whether the sale resulted in a gain or loss. So kahit nalugi, meron ka pa rin babayaran na tax. And the final tax rate is 6% based on gross selling price of the property, or fair market value, whichever is higher. So please take note of those underlined words, because those are the qualifications for it to be considered under capital gains taxation. So for sale of shares of stocks, it must be of a domestic corporation. So dapat ang nagmamay-ari ng share of stocks is a domestic corporation that is not listed in the local stock exchange or the Philippine Stock Exchange in our country. And these shares of stocks must be held as capital asset for it to be qualified under capital gains taxation. For real property, the property must be located in the Philippines and it must be held as capital asset, meaning hindi siya ginagamit for business purposes. It is held for investment. Now, in filing for capital gains taxation, the tax is due within 30 days from the date of sale. So, dapat bayaran mo na siya sa BIR within 30 days from the date of sale. Now, an illustration on the sale of shares of stocks of a domestic corporation. Let's say, for example, that a company is a domestic corporation that sold its shares of stocks of a domestic corporation not listed and traded in a local stock exchange held as investment at a capital gain of 30,000. How much is the capital gains tax? So let's look into the requirements for it to be considered under capital gains taxation. The shares of stocks must be of a domestic corporation, and in here, a company sold its shares of stocks of a domestic corporation. So, pasok. Next, not listed and traded in a local stock exchange. Again, pasok pa rin siya. And held as investment. When I say held as investment, it is considered as capital asset. So all of the requirements for it to be considered under capital gains taxation was met. So in here, the final tax is 15% based on the net capital gain, which is selling price less cost. In here, the capital gain is already indicated, which is 30,000. So 30,000 times the final tax of 15%, the capital gains tax therefore is equal to 4,500. So 30,000 times 0.15 is equal to 4,500, and that is the capital gains tax. We have another example. In here, B company. B company is a domestic corporation that sold for 100,000 shares of stocks of a domestic corporation not listed and traded in the local stock exchange, held as capital asset at a cost of 120,000. How much is the capital gains tax? Now, B company is a domestic corporation. Binenta niya yung shares of stocks niya na isang domestic corporation din. Okay, so pasok dun sa requirement number 1. Not listed and traded in the local stock exchange. So pasok dun sa requirement number 2. Held as capital asset. So pasok dun sa third requirement. Okay, so this transaction falls under capital gains taxation. And the final tax is 15% based on net capital gain. Hindi niya sinabi dito kung magkano ang net capital gain. Rather, nilagay niya dito yung selling price, which is 100,000, and the cost, which is 120,000. The selling price is 100,000 against the cost of 120,000. 100,000 minus 120,000, wala siyang gain, kundi meron siyang loss. Okay, so this transaction resulted to a capital loss rather than a capital gain. Nalugi siya. Okay, and sabi dito, there is only a tax if the sale resulted in a gain. So our answer will be 0. There is no capital gains tax if the sale resulted to a loss. Okay, another illustration for sale of shares of stocks. So here we have C Company. So C Company, a domestic corporation, sold for 140,000 shares of stocks of a domestic corporation listed and traded in the local stock exchange held as capital asset at a cost of 100,000. Okay, now let's analyze. So, C Company, nagbenta siya ng shares of stocks of a domestic corporation. Ang requirement natin dapat, domestic corporation yung shares of stocks. Okay? Yung nag-issue ng shares of stocks. And in here, pasok sa requirement. Ang binenta niya is shares of stocks ng domestic corporation. Sa next requirement, it must not be listed or traded in the local stock exchange. Okay? In here, ang nakalagay, it is listed and traded in the local stock exchange. So, hindi na siya pasok dito sa second requirement. Although the third requirement held as capital asset, pasok siya dito. Okay? So, dun sa second requirement, hindi siya pasok. So, our answer will be 0. Okay, so there is no capital gains tax since the shares of stocks are listed and traded in the local stock exchange. So please take note that all of these requirements, domestic corporation not listed and traded in the local stock exchange and held as capital asset must be present for it to be considered as under capital gains taxation. So in here, this transaction will fall under other stock and transaction tax. Okay, let's have another illustration. So let's have G Company. G Company, a domestic company, sold for 80,000 shares of stocks of a domestic corporation not listed and traded in the local stock exchange and held as capital asset. Now, meron siyang broker's fees on the sale. Okay, nung binenta niya, nag-hire siya ng isang broker at binigyan niya ng 3,000. The shares of stocks were purchased at 43,000. So, nabili niya noon ng 43,000. At nagbayad din siya ng broker's fee ng 1,500 nung bumili siya ng stocks. Okay. How much is the capital gains tax? Now, in our requirements, the shares of stocks must be of a domestic corporation. And in here, the shares of stocks were of a domestic corporation. So the first requirement was met. Not listed and traded in the local stock exchange. Again, the next requirement, the second requirement, not listed and traded in the local stock exchange was met. And held as capital asset. So, held as capital asset. So, all of the requirements were met in this transaction. Okay? Meron ba siyang gain? Okay? So, let's look into the selling price, okay, of 80,000. 80,000 yung kanyang pinagbentahan, kaya lang nagbayad siya ng 3,000. Okay? So, 80,000 minus 3,000, meron siyang net sales na 77,000. So, ang pumasok lang sa kanya is 77,000. Kasi pinambayad din niya sa broker's fee yung 3,000. Now, let's deduct the cost. Okay? The purchase price was 43,000. Kaya lang nagbayad siya ng broker's fee nung bumili siya. In this case, nadagdagan yung pinabili niya. Okay, so 43,000 plus 1,500 is 44,500. So gumastos siya lahat-lahat ng 44,500. At ang pumasok lang sa kanya is 77,000. 77,000 net sales less the total cost of purchase of 44,500, still mas mataas pa rin yung selling niya or sales niya kesa dun sa purchase niya. So, meron pa rin siyang net capital gain of 32,500. So, this net capital gain will be subject to final tax of 15%. Therefore, our capital gains tax for G company is 4,875. So that is how to compute for the net capital gain and the capital gains tax should there be broker's fees that are included in the transaction. Now, let's discuss another transaction under capital gains taxation, and this time, the sale of real property. When you say real property, these are properties that are attached to the soil and they are immovable. So, example are building and land. So, in this transaction, the sale of property must be located in the Philippines. So, the real property must be located in the Philippines and the real property must be held as capital asset. Now, in this case, there is a tax whether the sale resulted in a gain or loss. So, unlike dun sa sale of shares of stocks, ang tinitingnan lang natin is kung meron siyang capital gain. Ang basis natin is kung meron siyang capital gain. Kung wala siyang capital gain, walang tax na babayaran under sale of shares of stocks. But in the sale of real property, meron kang babayaran na tax whether the sale resulted in a gain or loss. So, kahit nalugi ka dun sa sale mo, magbabayad ka pa rin ng tax. And the rate is 6% final tax, which is based on the gross selling price or fair market value, whichever is higher. So, ang basihan natin is either the gross selling price, kung magkano yung pinagbentahan mo, or kung magkano yung fair market value niya nung time na binenta mo. Okay? So, pwede kasi makuha yung fair market value based on kung magkano yung assessed value ng lupa or magkano yung value niya in the market. So, let's have an example. J Company, a domestic company, sold a parcel of land located in Tagaytay, held as capital asset with a capital gain of 2,500,000. The selling price is 7,500,000. Fair market value is 10 million. How much is the capital gains tax? Okay, let's look into the requirements. According to the requirements, the real property must be located in the Philippines. In our illustration, the parcel of land is located in Tagaytay. Tagaytay is a place in the Philippines. So, the first requirement was met. Next, it must be held as capital asset. In the problem, it is indicated that it was held as capital asset. So again, the second requirement was met. So this transaction falls under capital gains taxation. Now, our final tax is 6%, which is based on gross selling price or fair market value, whichever is higher. Okay? So, in our problem, ang pagbabasehan natin is the selling price or fair market value, whichever is higher. Okay? So, in our case, the selling price is 7,500,000, while the fair market value is 10 million. So in J company, fair market value is higher. So that will be our basis. So 10 million times final tax of 6%. So this is equivalent to 600,000. So 600,000 ang babayaran na capital gains tax dun sa BIR ng seller. Okay? Now, what about the capital gain? Okay? The capital gain of 2,500,000 in this case will be ignored because hindi naman yan ang basehan dun sa sale of real property. Okay? Our basis will be the gross selling price or fair market value, whichever is higher. Unlike dun sa sale of shares of stocks, ang basehan natin is net capital gain. In the sale of real property, our basis is gross selling price or fair market value, whichever is higher. Another illustration, this time D company. D company sold its factory building at a capital gain of 1,500,000. Ang selling price niya is 4,500,000 at ang cost niya is 3 million kaya nagkaroon siya ng capital gain na 1,500,000. The fair market value of the factory building is 5 million. Now, ang tinatanong, how much is the capital gains tax? Let's analyze the problem. Did it meet the requirements as stated in our rules? Okay, ang binenta niya is factory building. Factory building is a real property. Okay? Located in the Philippines and held as capital asset. Okay. Wala siyang sinabi dito kung located in the Philippines or not. And it must be held as capital asset. Factory building is a building that is used for the factory, for the manufacturing of the products of a business. Di ba, meron tayong sinasabi ng dalawang klase ng asset. Ordinary asset, tsaka capital asset. Ordinary asset are those assets that are used in the business. And capital asset are those that are held for investment. They are not used in the business. In this case, the factory building is considered as an ordinary asset. It is not a capital asset. So our answer will be 0 because the factory building is not considered as a capital asset but an ordinary asset. So it did not qualify our requirements. Okay, next illustration. So we have E company, a domestic corporation, sold a parcel of land located in Sabah, Malaysia at a capital gain of 450,000. The selling price was 3,400,000. The cost was 2,950,000. The fair market value at the time of sale is 3,500,000. How much is the capital gains tax? Okay, so let's analyze the problem. So let's look into the requirements. It must be located in the Philippines. Okay, in the case of E company, the parcel of land is located in Sabah, Malaysia. So therefore, hindi siya pasok dun sa requirements. It did not meet the requirements specified in our rules on the sale of real property. So therefore, the answer is 0 because the land is located in Sabah, Malaysia. Higher, I should say, than the selling price of 2.3 million times the final tax rate of 6% or 150,000. So magbabayad pa rin si F company ng 150,000 as capital gains tax although it encountered a capital loss of 700,000. Okay? Because in reality, it is assumed that when you sell a real property, there is a gain. Because land or building, tumataas usually yung market value niya. Especially yung land. Okay? So, in this case, kahit merong capital loss, meron ka pa rin babayaran na capital gains tax. Capital gains tax is a final tax. Okay? Pero hiniwalay dun lang siya dun sa final income taxation. Now, let's go into final income taxation. Final income taxation transactions include interest under the expanded foreign currency deposit system, which is final tax of 15%. Interest income from deposits, short-term man siya or long-term, any currency, maybe dollar or Philippine peso. Deposit substitutes, trust funds, or royalties will be charged final tax of 20%. And dividend from domestic corporation. Take note that we are taxing the domestic corporation and it receives a dividend from domestic corporation. We're looking into the taxability of domestic corporation. Okay? Si domestic corporation naka-receive ng dividend from another domestic corporation. So, ang tawag doon is intercompany dividend. Okay? Pag domestic corporation naka-receive ng dividend from another domestic corporation, it will be exempt from final income taxation. So, wala siyang babayaran na final income taxation. So, dalawang rates ang i-memorize natin. Final tax of 15% for those interest under the expanded foreign currency deposit system. And the interest income from deposits. Short-term man yan or long-term. Final tax of 20%. So in here, final income taxation, tax is already withheld at source. So meaning, the income you receive is tax paid already. Nabayaran na yung tax doon. So when a corporation puts its money in the bank, it earns an interest. At ang nakikredit na doon sa passbook niya is the interest net of tax. Naibabawas na doon mismo yung tax. Meaning, hindi ka na nagpa-file ng return dito you do not need to pay the tax doon sa BIR. Kasi binabawas na siya mismo ng bangko. Okay. So, let's have an example. So, here are the passive income. So, meron siyang 6 na income na na-receive ang isang domestic corporation. So, let's analyze each type of passive income kung pasok ba siya under final income taxation or pasok ba siya as corporate income taxation. So, unahin natin, interest income under the expanded foreign currency deposit system, 12,000. So, this transaction falls under interest under expanded foreign currency deposit system. So, ang income tax scheme nito is final tax or final income taxation. And the rate is 15%. So, in order to get the final tax, 12,000 times the final tax of 15% will give you 1,800 pesos. So, yan na yung i-deduct dun sa deposit mo. Dun sa income, sa interest income na magre-reflect doon sa deposit mo. So, ang magre-reflect na interest income sa'yo is 10,200. For the domestic corporation, as you say, is 10,200. It is already net of the final income tax. So, 12,000 minus 1,800 or 10,200 200 pesos. Next, interest income for savings deposit at ABC Bank. Okay, 50,000. Okay, so let's look again into these transactions kung saan pwedeng mag-fall under final income taxation. And this second transaction falls under interest income from deposits. So, the income tax scheme applicable to this is final income taxation and the rate is 20%. So, the final tax is 50,000 times 20% or 10,000. So, 10,000 yung babayaran na final tax or yun yung i-deduct dun sa savings deposit, dun sa interest income, dun sa savings deposit ni ABC Bank. So, ang marireceive dun sa passbook na maidadagdag dun sa savings ni ABC ng isang domestic corporation is 40,000. That is 50,000 net of the final tax of 10,000. So, the income received will be 40,000. Next, dividend income received from GHI Company. Now, GHI Company is a resident foreign corporation and the dividend income amounts to 23,000. Okay, let's look into the transactions qualified under final income taxation. Ang dividend na meron dito is dividend from a domestic corporation. Here in GHI, it is not a domestic corporation but rather a resident foreign corporation. Therefore, hindi siya pasok sa final income taxation. When a passive income does not fall under the final income taxation scheme, it falls under corporate income taxation, another income tax scheme, yung pangatlong income tax scheme. So, wala siyang final rate at wala siyang final tax. So, ang marireceive niya is 23,000 but this 23,000 will be subjected to corporate income tax. Sa ibang tax siya papasok. But for final income taxation, hindi siya pasok. Next is dividend income received from DEF Company. DEF Company is a domestic corporation at ang na-receive na dividend income is 32,000. Let's look into the transaction that falls under final income taxation. Dividend from a domestic corporation. DEF Company is a domestic corporation. So, pasok siya dito sa transaction under final income taxation. So, the income tax scheme applicable for this transaction is final income taxation or final tax. And the rate is exempt kasi exempt dun sa rules natin. So, wala siyang babayaran. So, exempt yung final tax niya or zero. So, ang marireceive na dividend income niya is 32,000 minus 0, di 32,000. Next is royalty on books. Okay, so the corporation received royalty on books of 43,000. Let's look into the qualified transactions under final income taxations. So, pasok siya dito sa pangalawa, royalty, so final tax of 20%. So, the income tax scheme is final tax. The final tax rate is 20%. So, the final tax therefore is 43,000 times 20% or 8,600. So, the income received will be 43,000 minus 8,600 or 34,400. Next is royalty from other sources amounting to 65,000. So, from the qualified transactions, pasok siya again dito sa pangalawa, royalty. So, the income tax scheme is final tax or final income taxation. And the final tax rate is 20%. So, 65,000 times 20% will give you 13,000. So the income received net of the final tax will be 65,000 minus 13,000 or 52,000. So that is how final income taxation works. Into corporate income taxation or yung tinatawag nila na regular corporate income taxation. So, under corporate income taxations are those income that requires active involvement of the taxpayer. So, example nito is the business income of domestic corporations. It also includes capital gains that were not subjected to capital gains tax. Yung mga hindi kasali dun sa capital gains tax na na-discuss kanina. So, example nito are sale of shares of stocks of a resident foreign corporation. And those passive income that were not subjected to final income taxation. So, example natin is interest on notes receivable. Or yung dividend from resident foreign corporation also falls under passive income not subject to final income taxation. Now, for the first 3 years of operation of the domestic corporation, the normal tax rate will be 30%. Beginning on its 4th year, so 4 years and above na yung operation ng isang business, it will be subjected to either normal tax rate of 30% or minimum corporate income tax of 2%. So in here, you will compare normal tax of 30% as against the minimum corporate income tax of 2%, and whichever is higher will be paid as the income tax. So, for the normal tax or regular corporate income tax, the formula will be gross income less itemized deduction or yung business expenses or losses, or the company may opt for the optional standard deduction, which is 40% of gross income. Deducting that from the gross income will make you arrive at taxable income and multiply it by the normal income tax rate of 30% to get the normal income tax. For the minimum corporate income tax, the formula will be gross income times the tax rate of 2% to get the minimum corporate income tax. So in MCIT, you do not deduct expenses or losses or deductions. Okay, you base it on gross income. Take note that gross income does not include capital gains that were already subjected to capital gains tax and passive income that were already subjected to final tax, but includes capital gains that are not subjected yet to capital gains tax and passive income that are not yet subjected to final tax. So, yun yung included in the gross income. When I say gross income, kung hindi given ang gross income dun sa problem, it can be derived by sales less cost of sales or sales minus cost of direct services. Have an illustration. Okay, so in here, DEF company, a domestic corporation, had the following income in its 3rd year or 3rd taxable year. So we have gross income from business, 3,250,000. Business expenses and losses, 2,450,000. Interest on Philippine currency bank deposit, 14,000. And capital gain on sale of land in Makati held as capital asset, 120,000. The requirement is to compute for the corporate income tax. Now, let's analyze each item in DEF company. First is the gross income from business. Okay, gross income from business is considered as income under corporate income taxation. So, pasok siya. Business expenses and losses. Again, pasok din siya. Interest on Philippine currency bank deposit. Anong klaseng income ba to? Capital gains, passive income or other income. So interest is considered as a passive income. Is this interest subject to final tax? Yes. So, hindi ito kasali because it is already subjected to final tax. Next, capital gain on sale of land in Makati held as capital asset. So, this is a sale of land. Okay? Meron siyang capital gain. This is land. And the land is located in the Philippines, in Makati in particular. And it is also held as capital asset. And we're computing for the corporate income taxation. Sabi natin, pag pasok na siya dun sa capital gains taxation, hindi na siya dapat kasali sa corporate income taxation. In this case, this transaction falls under capital gains transaction, so hindi na siya kasali dun sa computation. So, our answer will be gross income from business, 3,250,000 less expenses and losses, 2,450,000. So, the taxable income is 800,000. You multiply it by the income tax rate of 30%. Therefore, the income tax is 240,000. Take note that DEF company is in its third taxable year. So, ang mag-a-apply lang sa kanya is normal tax of 30%. Okay, we don't need to compare it with minimum corporate income tax kasi nasa third year pa lang siya. Okay, ano corporation? JKL Company, a domestic corporation, had the following income in its fifth taxable year. So, nasa fifth year na siya. Okay? Gross income from business, 1,235,000. Interest on notes receivable, 54,000. Operating expenses, 763,000. Now, let's analyze each item. Gross income from business falls under corporate income taxation. So, pasok siya. Interest on notes receivable. Now, interest on notes receivable is not considered as a passive income that is subject to final tax. Kasi ang sinasubject lang natin sa final tax are those interest on banks, deposits, substitutes, royalties. Hindi pasok ang notes receivable sa final income taxation. So, pag hindi siya pasok sa final income taxation, pasok siya sa regular income taxation or corporate income taxation. Operating expenses are part of corporate income taxation. So, since it is already in its fifth taxable year, we're going to compute for the normal tax of 30% and MCIT of 2%, and whichever is higher will be paid as the income tax. So, unahin natin yung normal tax. So, for the normal tax, gross income from business, 1,235,000 plus the interest on notes receivable, 54,000. So, kung mapapansin niyo, ina-add natin dito yung mga income, yung mga passive income that were not subjected to final tax. Yung mga hindi sinali dun sa final tax, isasali natin dito. O yung mga capital gains na hindi subject sa capital gains tax, isasali natin dito. Okay? So, total of 1,289,000 lahat ng income. Less the operating expenses of 763,000. So, the taxable income is 526,000. Multiply it with 30% to get the normal income tax of 157,800. Now, we're going to compare this with the minimum corporate income tax, which is gross income from business of 1,235,000 plus interest on notes receivable of 54,000 for a total of 1,289,000 times 2% income tax rate. Take note that in MCIT, we do not deduct expenses. So, 1,289,000 times 2%, the minimum corporate income tax is 25,700 So since the normal income tax of 157,800 is higher than the MCIT of 25,780, the tax to be paid for the year is 157,800. So ito yung follow natin since ito naman yung mas mataas. So when a business is already in its fourth year and above, magko-compare ka na ng normal tax and MCIT. And whichever is higher will be paid as the corporate income tax. Now, when we say income tax expense, this is the sum of the following: capital gains tax plus final tax and normal tax. So for a more comprehensive illustration, I am giving you this assignment of JU's company, domestic corporation, which had the following data in its fifth taxable year. So nasa fifth year na siya. So andito yung mga details, yung mga sources of income and expenses niya. So what you're going to do is to identify if what income tax scheme will these items of income and expenses will fall. So saan siya? Is it final tax, capital gains tax, or corporate income tax? So pagka nalagay mo na yung mga classifications yan, then you're ready to compute or determine the following 8 requirements. So what I am expecting you to do is to compute for the items required. So, you please write your solutions in good form on a separate sheet of paper with your name on it. And then take a photo of it and then send it to my messenger account. And then we're going to discuss the answer of this problem on our synchronous meeting. So this is what you're going to do on our next meeting. So after the said activity, our next lesson will be excess MCIT carry forward and quarterly income tax on corporations. Thank you and see you again.